First, our top story. The U.S. Federal Reserve Chair Janet Yellen is preparing global markets for the anticipated first interest rate rise in more than 6 years. That increase could come sometime in the coming months if the U.S. economy continues to chug along. But there are a couple of big reasons why it's also tricky for Janet Yellen as well. Daniel Wrenches has this.
As head of America's central bank, Janet Yellen has clearly expressed her distaste for political pressure on monetary policy decisions. That's not stopped some members of the Senate Banking Committee from dispensing their advice.
Let me urge you to act with caution before raising rates.
Madam Chairman, I know you and I disagree on this, but I would just suggest the crisis is clearly long over. I think the time for normalization is well overdue.
In her testimony to Congress, Yellen is shifting towards normalization. With the strengthening economy, she thinks an interest rate rise will occur sometime after the Federal Open Market Committee takes the word patient out of its forward guidance language.
The modification should be understood as reflecting the committee's judgment that conditions have improved to the point where it will soon be the case that a change in the target range could be warranted at any meeting.
Despite an upbeat view of the labour market and dropping unemployment, Yellen still has concerns about slow wage growth and the quality of jobs being created. Inflation is another complicating factor. It remains low for the Fed, though Yellen thinks this may be a short-term impact from the recent low oil prices. And despite signs of a slowdown in China and Europe, Yellen thinks the impact of cheap energy and stimulative monetary policies from other central banks could mitigate those global risks. So if the American economy continues to power forward and if inflation picks up, as Yellen expects, then a rate rise sometime this year is a strong probability, providing the Fed can be patient. Daniel Wrenches, CCTV, Washington.